$93,000. That's where Bitcoin traded on January 5th, 2026, according to CoinDesk and multiple exchange data feeds. And if you're confused about how crypto is surging when 2025 was supposed to be a disaster, you're not alone. Because here's what most coverage missed. While Bitcoin crashed 30% in October and $150 billion in leveraged positions got liquidated according to CoinGlass data, the actual scale of forced closures may have been significantly larger than public reports indicated. Research from analysts suggests the real number could have been $30 to $40 billion in the October event alone. And that gap between official reports and market reality, that's the story. I spent 72 hours reading liquidation data from CoinGlass, analyzing exchange infrastructure changes documented by research firms, and tracking institutional flows to understand what actually happened in 2025 and why Bitcoin is breaking out in 2026, despite one of the most volatile years in crypto history. Not headlines, not exchange press releases, just publicly available data about leverage, liquidations, and structural market changes. By the end of this video, you'll understand why $150 billion in documented liquidations represents only part of the leverage story. You'll see exactly how major exchanges modified their data infrastructure in 2021, according to research analysts. And you'll know why Bitcoin hitting 93K coin right now isn't despite the crisis. It's partly because of what the crisis cleared from the system. But first, let me show you something that doesn't add up. 2025 was supposed to be crypto's year. Trump got elected in November 2024, promising to make the US the crypto capital of the world. The Genius Act passed in July 2025. Paul Atkins became SEC chairman in April 2025. Everything looked bullish. So why did Bitcoin end 2025 down approximately 6% while the S&P 500 gained double digits according to market data? That contradiction reveals everything about what actually happened. Let's start with the documented facts of 2025. Bitcoin reached an all-time high of approximately $126,198 in early October 2025, according to multiple price feeds. Not 100K, not 120K, around $126,198. And then October 10th happened. In less than 48 hours, Bitcoin crashed from approximately $126,000 to around $102,000, according to exchange data. That's roughly a $24,000 drop, approximately a 19% decline in 2 days. Official liquidation tracking from CoinGlass reported $19.1 billion in forced position closures during the October 10-11 period. Every major outlet cited that figure. But according to research from analysts, including one known as Yan, cross-exchange analysis suggested the true liquidation scale could have reached $30 to $40 billion. That's not speculation. That's based on order book depth analysis and cross-venue position tracking that revealed discrepancies between reported and actual liquidation activity. Why would there be a discrepancy? According to K33 research analyst Vetle Lund, Binance, Bybit, and OKX modified their WebSocket APIs in 2021 in ways that reduced the granularity of publicly available liquidation data. They didn't eliminate liquidation reporting entirely, but the changes made comprehensive tracking more difficult. The result, according to Lunde's research, was what he described as a vast underrepresentation of actual market leverage in public data feeds. During the October crash, Hyperliquid, a decentralized exchange that publishes all liquidations on-chain for full transparency, reportedly recorded $6.7 billion in liquidations according to market reports. That's one exchange. Meanwhile, centralized exchanges with exponentially higher trading volumes reported figures that, according to some analysts, seemed inconsistent with the price action and order book behavior observed across venues. Why does this matter? Because liquidation data is supposed to help traders understand systemic risk. If the publicly available data understates actual liquidations by a factor of 2 or 3, traders are operating with incomplete information about how much leverage exists in the system. That creates potential for unexpected cascading liquidations when markets become stressed. So what triggered the October crash? It wasn't just crypto-specific factors. On October 10th, according to news reports, President Trump announced a 100% tariff on Chinese imports. Traditional equity markets sold off. The Nasdaq dropped. S&P futures declined. And crypto, which had been trading increasingly as a risk-correlated asset throughout 2025, experienced amplified selling pressure. But the magnitude of the crash wasn't just about the tariff news. According to market analysis, it was about positioning. By October 2025, crypto derivatives markets had reached record open interest according to exchange data. Open interest measures the total value of outstanding derivative contracts. High open interest with concentrated positioning creates vulnerability to rapid unwinding. According to post-crash analysis from multiple sources, estimates suggested that 85% to 90% of liquidated positions in the October event were long positions, meaning traders betting on price increases. When everyone's positioned the same direction and prices move against them, liquidations cascade. Each forced closure creates selling pressure. That selling pressure triggers more liquidations. It's a self-reinforcing cycle. Here's how liquidation mechanics work. The trader deposits $10,000 as collateral. They borrow an additional $90,000 to control a $100,000 position. That's 10x leverage. If the asset price drops 10%, the trader's $10,000 collateral is exhausted. The exchange automatically closes the position to prevent the trader from owing money beyond their collateral. That's a forced liquidation. Now scale that dynamic to billions of dollars across potentially millions of positions. When Bitcoin dropped from $126,000 to $102,000, it triggered maintenance margin calls across the system. Those margin calls forced position closures. The closures created additional selling pressure. That pressure pushed prices lower still. Lower prices triggered additional margin calls. According to FTI Consulting's analysis of the event, this cascade dynamic was the primary driver of the severity and speed of the decline. But the liquidation mechanics reveal only part of the story. Let me show you something that demonstrates how exchange microstructure amplified the volatility. During the October crash, USDE, a stablecoin designed to maintain a 1.1 value with the US dollar, briefly traded in the mid-0.60s on Binance according to FTI Consulting's analysis. That's approximately a 35 to 40% discount to its intended peg. Why does this matter? Because many traders use stablecoins as collateral for leverage positions. Binance's margin system, like most centralized exchanges, priced collateral using the exchange's own internal price feeds. When USD crashed to around 0.60 on Binance while staying closer to $1 on other venues, traders holding USD as collateral on Binance saw their collateral value marked down dramatically on Binance's system. Positions that would have remained solvent under cross-venue pricing got liquidated on Binance simply because Binance's local market for USDE temporarily traded through the peg. According to FTI Consulting, this wasn't about USDE's fundamental backing. It was about venue-specific order book dynamics and how local pricing fed into margin calculation systems. Thousands of accounts potentially faced forced liquidation because of temporary pricing dislocations on a single venue. FTI Consulting's research documented that order book depth on major Bitcoin trading venues shrank by more than 90% during the worst of the selling. Bid-ask spreads, which normally measure in single-digit basis points, widened to double-digit percentages at the extremes. Liquidity, the ability to execute trades without moving the price significantly, essentially evaporated during the most intense selling period. When liquidity disappears in a highly leveraged market, prices gap violently. Market makers, the firms that normally provide continuous buy and sell quotes, either widened their spreads dramatically or stepped away entirely according to microstructure analysis. The result was a market where sellers vastly outnumbered available buyers at any reasonable price. So here's the question that wasn't being asked enough in October. If crypto had record institutional adoption, improving regulatory clarity, and support from a pro-crypto presidential administration, why did the crash happen with such severity? According to post-event analysis from multiple research firms, the answer is concentrated leverage on centralized infrastructure with limited real-time transparency about systemic positioning. Total crypto derivatives trading volume in 2025 reached $85.70 trillion, according to industry reports compiled by research firms. That's trillion with a T. $85.70 trillion in notional trading volume. Daily turnover averaged $264.5 billion. But here's what matters for understanding the October crash. Most of that volume involved leverage, and most of that leverage concentrated on a relatively small number of centralized exchanges. Now let me show you what happened after October bottomed. Bitcoin found support around $83,000 in late 2025, according to price data. It spent most of November and December trading between $85,000 and $90,000. Price volatility compressed significantly. The Bollinger Bands, a technical indicator that measures price volatility, narrowed to their tightest range since July 2025, according to TradingView data. Market participants described this as a squeeze or coiling pattern. Then January 2026 started. January 2nd, Bitcoin pushed above $90,000 during U.S. trading hours, according to CoinDesk reporting. That's notable because throughout late 2025, Bitcoin typically experienced selling pressure during American market hours. The pattern reversed. January 4th, Bitcoin briefly touched $91,000 as news broke about U.S. military operations in Venezuela, according to multiple news sources. January 5th, Bitcoin reached $93,000, according to exchange data. Why is Bitcoin surging in early 2026 despite 2025 being challenging? Market analysts point to several factors. First, the October liquidation event flushed excessive leverage from the system. CoinGlass data shows $150 billion in total liquidations across 2025, with analysts suggesting the real figure accounting for underreported events could be significantly higher. The over-leveraged positions that created October's fragility are largely cleared. Second, institutional demand continued throughout the volatility according to multiple data points. Despite Bitcoin falling 30% from its October high, spot Bitcoin ETFs saw continued net inflows in Q4 2025 according to ETF tracking data. Tether, the largest stablecoin issuer, purchased 8,888 Bitcoins on December 31, 2025, worth approximately $780 million according to their announcement. This brought their publicly disclosed Bitcoin holdings to over 96,000 BTC. According to CryptoQuant data, new crypto whale addresses, defined as wallets holding significant Bitcoin quantities, accumulated over 100,000 BTC during Q4 2025, despite the market weakness. That represents over $8 billion worth of Bitcoin purchased, while sentiment was negative. The pattern suggests that longer-term institutional capital was accumulating during price weakness. Third, market structure evolved in important ways during 2025. The Chicago Mercantile Exchange, CME, a regulated U.S. derivatives exchange, overtook Binance in Bitcoin futures open interest during late 2025, according to market data. This represents a significant shift. CME operates under U.S. regulatory oversight with institutional-grade infrastructure and transparency requirements. CME's cryptocurrency complex achieved record average daily volume of 424,000 contracts in November 2025, representing $13.2 billion in notional value according to CME's public reporting. That's a 78% increase year over year. CME also launched spot-quoted futures contracts with tickers QBTC and QF designed to reduce basis risk between futures and spot prices. What this signals is that institutional capital is increasingly trading crypto through regulated venues rather than offshore exchanges. When BlackRock's IBIT Bitcoin ETF options surpassed Deribit, previously the dominant offshore options venue, in open interest by Q3 2025, it confirmed that traditional finance institutions now have comparable pricing influence to crypto-native platforms. But let's examine the transparency issues that became apparent during October. I've discussed liquidation reporting discrepancies. Let me explain the mechanics more completely. During normal market conditions, exchange liquidation processes work as follows. When a trader's margin falls below maintenance requirements, the exchange liquidates the position by selling it into the order book, uses insurance funds to cover any shortfall if the position closes at a loss, and the trader's remaining collateral after covering the loss is returned. This process generally works during ordinary volatility, but during extreme events like October, insurance funds can be insufficient to cover all losses from liquidated positions. That's when exchanges implement auto-deleveraging, or ADL. ADL is a backstop mechanism where exchanges forcibly reduce profitable positions on the opposite side of liquidated trades to cover losses that exceed insurance fund capacity. According to multiple trader reports and exchange documentation, ADL triggered across several major venues during October. This means traders holding profitable positions who did nothing wrong and managed their risk appropriately had portions of their positions forcibly closed by the exchange to cover losses from other traders' liquidations. The challenge with ADL is that most exchanges don't provide advance notice of exactly when and how it will trigger. Traders discover after the fact that their positions were partially closed. For traders running multi-venue arbitrage strategies, this creates significant risk because ADL on one venue can leave them with unhedged exposure on other venues. FTI Consulting's analysis revealed another structural issue. Many centralized exchanges calculate margin and collateral value using single-venue pricing. If you trade on Binance and hold positions collateralized on Binance, your margin is calculated using Binance's price feeds. If Binance's local order book experiences a temporary dislocation due to liquidity issues, your collateral gets marked to Binance's distressed price even if prices on Coinbase, Kraken, and other venues remain stable. The solution to this problem, according to risk management experts, is multi-venue, liquidity-weighted pricing with outlier controls. Calculate collateral value using median prices across multiple exchanges, exclude obvious outliers, and value positions based on where they could actually be liquidated across the market, not just where one venue briefly traded. However, most centralized exchanges don't implement this because the infrastructure is complex and expensive to build and maintain. It's important to note that exchanges face genuine risk management challenges. They're providing leverage to traders and need to ensure they don't end up with losses if traders' positions move against them faster than collateral can be liquidated. The challenge is balancing that risk management need with providing accurate market information and fair treatment of traders across different venues and market conditions. Now let me explain why Bitcoin reaching 93K in early January 2026 represents a potentially healthy market development despite 2025's difficulties. First, deleveraging events, while painful, remove fragility from the system. Excessive leverage creates vulnerability to cascading liquidations. The October event forced a reset. Open interest declined. Funding rates, which measure the cost of holding leveraged positions, normalized. The market entered 2026 with less crowded positioning. Second, institutional adoption accelerated throughout 2025 despite price volatility. Strategy, the company formerly known as MicroStrategy, continued aggressive Bitcoin accumulation throughout the year. According to research tracking corporate Bitcoin holdings, at least 172 publicly traded companies held Bitcoin on their balance sheets by Q3 2025, collectively holding approximately 1 million BTC. This represents institutional adoption at meaningful scale. Third, regulatory clarity improved substantially in 2025. The Genius Act, signed into law in July 2025, established federal rules for stablecoins. Paul Atkins became SEC chairman in April 2025, bringing a more measured regulatory approach to crypto markets. The Clarity Act passed the House of Representatives, proposing to shift primary crypto oversight to the Commodity Futures Trading Commission. These are enacted policies and confirmable legislative actions. Fourth, the 4-year Bitcoin halving cycle may be evolving, but that's not necessarily bearish according to market analysts. Historically, Bitcoin has rallied in the year following each halving event. 2024 was the 4th halving. 2025 should have theoretically been a strong year. Instead, Bitcoin fell approximately 6% for the year. That makes 2025 the first negative post-halving year in Bitcoin's history. But analysts like Mati Greenspan from Quantum Economics argue this doesn't represent Bitcoin failing. According to his analysis shared with CoinDesk, it represents Bitcoin maturing. The old cycle drivers, halvings, interest rate changes, and retail leverage are becoming weaker influences. The emerging drivers are institutional capital flows, regulatory developments, macroeconomic conditions, and expanding real-world utility like stablecoin adoption. These factors play out over years, not months. Galaxy Digital analysts noted that despite negative price returns in 2025, Bitcoin ETFs saw continued net inflows. That's remarkable. Price fell 30% from the October high, yet institutional capital continued flowing into regulated Bitcoin investment vehicles. The explanation is that institutions aren't trading daily volatility. They're positioning for multi-year adoption trends. Here's what makes the 2025 experience unusual from a macro perspective. Global liquidity expanded significantly in 2025. Central banks, including the Federal Reserve, ended quantitative tightening and expanded their balance sheets according to central bank data. Historically, such liquidity expansion has been associated with strong Bitcoin performance, but in 2025, while gold and silver surged with triple-digit percentage gains, Bitcoin underperformed. One theory from analysts is that Bitcoin got repriced as a risk asset during the October period. It shifted from trading like digital gold to trading more like a technology stock. When risk appetite declined, Bitcoin fell alongside equities. But as 2026 begins, that correlation appears to be weakening again. Bitcoin is rising during a period of increased geopolitical uncertainty, suggesting renewed safe haven demand characteristics. So what comes next? Wall Street analysts are divided in their forecasts. Some project Bitcoin reaching $150,000 to $170,000 in 2026 under scenarios of Federal Reserve easing and continued institutional adoption. Others forecast a more conservative $70,000 to $100,000 range if economic conditions remain challenging. The wide divergence in forecasts reflects genuine uncertainty about macroeconomic conditions and their impact on risk assets. But several factors are documentable. First, positioning entering 2026 is lighter than it was entering Q4 2025. After 150 billion in liquidations, crowded leverage trades are significantly reduced. Lower leverage means less vulnerability to cascading liquidations if volatility increases. Second, Trump's administration has implemented crypto-friendly policies. Regulatory tailwinds that began in 2025 continue into 2026. Reports indicate that JP Morgan Chase, the world's largest bank by assets, is considering offering crypto trading services to institutional clients, according to Bloomberg reporting. That represents potential mainstream financial infrastructure integration. Third, corporate treasury adoption of Bitcoin continues expanding. Digital asset treasury companies, or DATs, which treat crypto accumulation as core business strategy, grew throughout 2025 despite price volatility. Some DATs face pressure as their market capitalizations approach or fall below their net asset values, but adoption by corporate treasuries as an asset class continues. Fourth, technical market structure showed Bitcoin consolidating in a tight $85,000 to $90,000 range for approximately 2 weeks entering 2026. This created what technical analysts call a Bollinger Band squeeze, the tightest volatility compression since July, according to TradingView data. Historically, such compression periods precede significant directional moves. The breakout to $93,000 confirms the consolidation resolved to the upside. Now let me address the microstructure changes that matter for understanding 2026. Coinbase, the largest US-regulated cryptocurrency exchange, acquired Deribit, the dominant offshore crypto options platform, for $2.9 billion in 2025, according to company announcements. This is significant because it represents a regulated US entity absorbing previously offshore liquidity and trading activity. It signals continued integration of crypto markets into regulated financial infrastructure. Spot Bitcoin and Ethereum ETFs continue expanding their footprint. Solana ETFs launched in late 2025 and gathered approximately $900 million in assets, despite overall market weakness, according to Soso Value data. XRP ETFs surpassed $1 billion in net inflows within their first month of trading. The consistent demand for regulated crypto investment vehicles continues even when underlying token prices face pressure. Why does ETF growth matter structurally? When BlackRock's IBIT or other ETFs purchase Bitcoin, that Bitcoin is removed from exchange trading and held in regulated custody. This reduces the circulating supply available for spot trading. Over time, assuming continued or growing ETF inflows, this creates structural upward pressure on prices by reducing available supply. Regarding exchange transparency issues, it's worth noting that the market is evolving. Hyperliquid demonstrated that a high-performance derivatives exchange can operate with full on-chain transparency, publishing all liquidations publicly. This proves the technical feasibility of greater transparency. Whether centralized exchanges will adopt similar approaches voluntarily, or whether regulatory pressure will be required, remains to be seen. In 2026, market observers are watching several key indicators. First, leverage levels as measured by open interest and funding rates on derivatives exchanges. If open interest surges rapidly while funding rates spike, that signals potentially excessive leverage building in the system again. That pattern preceded October's issues. Second, exchange infrastructure and transparency developments. If more platforms adopt comprehensive liquidation disclosure or multi-venue pricing for margin calculations, that would represent structural improvement. If existing practices continue unchanged, the vulnerabilities that contributed to October's severity remain. Third, institutional adoption metrics, including CME open interest relative to offshore exchanges, ETF flow data, and corporate treasury Bitcoin accumulation announcements. These are slower moving indicators, but they reveal the long-term trajectory of institutional capital allocation to Bitcoin. Fourth, regulatory developments including potential Senate passage of the Clarity Act, implementation of stablecoin regulations under the Genius Act, and international coordination on crypto market structure. The regulatory environment shapes market structure and institutional participation. Fifth, macroeconomic conditions, including Federal Reserve policy, inflation trends, US dollar strength, and geopolitical developments. Bitcoin increasingly trades as a macro asset, responding to liquidity conditions and risk sentiment in traditional markets. So here's what the data tells us about 2025 and early 2026. 2025 was the year institutional crypto adoption accelerated, while the market simultaneously experienced one of its most severe leverage-driven corrections. Record regulatory progress met record liquidation events. A pro-crypto presidential administration took office in the same year that leverage vulnerabilities created a $30–40 billion liquidation event, according to analyst estimates. The October crash wasn't a failure of Bitcoin's fundamental value proposition, according to market analysts. It was a liquidity event triggered by macroeconomic stress, concentrated positioning, and leverage. It exposed how gaps in public liquidation data make it difficult for market participants to assess systemic risk. It revealed how single-venue pricing for margin calculations can create venue-specific liquidation cascades. And it demonstrated how concentrated positioning amplifies volatility in both directions. But the October event also cleared excessive leverage from the system. The most vulnerable positions were closed, overextended traders were liquidated, meanwhile institutional capital continued accumulating, infrastructure continued improving, regulatory clarity continued progressing, and now, entering 2026, Bitcoin is trading at $93,000, up significantly from the late 2025 lows around $83,000. The gap between public liquidation reports and analyst estimates of actual liquidation activity reveals challenges in crypto market transparency. When K33 research documents that major exchanges modified data infrastructure in ways that reduced liquidation data granularity, it highlights the difficulty market participants face in accurately assessing systemic risk. The business model of crypto exchanges involves generating revenue from trading fees. Higher trading volume, including volume from liquidation events, generates more fee revenue. This creates a potential tension between comprehensive transparency about liquidation activity and exchange business incentives. That tension doesn't require assuming malicious intent, but it does mean market participants should be aware that publicly reported liquidation data may not capture the complete picture of forced closures. But here's what gives informed observers confidence about Bitcoin's resilience. Despite a 30% drawdown from the October high, despite $150 billion in documented liquidations, despite challenging macroeconomic conditions in Q4 2025, Bitcoin entered 2026 trading above $90,000 and quickly moved to $93,000. Institutional capital continued flowing into ETFs, corporate treasuries continued adding Bitcoin to balance sheets, infrastructure continued maturing. You now have the documented facts, the timeline of events, the structural explanations for October's severity. You understand why $19 billion in official liquidation reports represents only part of the story, with analyst estimates suggesting true scale could have been 30 to 40 billion. You know how exchange infrastructure changes affected data availability. You understand why Bitcoin trading at $83,000 in late 2025 set the foundation for the $93,000 breakout in January 2026. If this analysis provided value, subscribe for continued coverage. I'll be tracking leverage metrics, exchange infrastructure developments, institutional flow data, and macroeconomic conditions that shape Bitcoin's path through 2026. Because understanding the difference between official reports and market reality is where the actual story lives. Bitcoin reached $93,000 in early January 2026, despite 2025 being one of crypto's most volatile years. That's not random chance. That's excessive leverage being cleared while institutional adoption continued. That's weak positioning being flushed while long-term capital accumulated. That's the market evolving from speculation-driven volatility toward institutional-grade infrastructure. The gaps in public liquidation reporting matter because transparency helps market participants assess risk accurately. The changes to exchange infrastructure that reduce data granularity matter because they affect how well traders can monitor systemic positioning. The structural improvements in custody, regulation, and institutional access matter because they're building foundations for the next phase of adoption. Now you understand what happened. The data is public, the analysis is documented, the implications are significant, and knowing the difference between official reports and comprehensive analysis changes how you evaluate market developments.